now that we've looked at the individual components, cost of capital, the cost of debt, the cost of equity, preferred stock, and common stock, as well as retained earnings, we're going to look at the overall capital structure and the overall cost of capital. One of the goals that management has is to reduce the overall cost of capital for the firm, and that's consistent with getting shareholders and bondholders the highest price that they can achieve for their stocks and bonds. Remember that yields are inversely related to price, and so the cost of capital for the company is inversely related to the value of its securities. So it wants to raise the value of its stocks, raise the value of its bonds, reduce the cost of debt and equity financing. And in order to make those decisions, we're first of all going to need to calculate the required returns and appropriate weights on our debt, preferred stock, common equity. And then we're going to adjust the level of each of those in a manner that we think will reduce and minimize our overall cost of capital for the firm. That for most of these firms, we're not going to have any preferred stock. We're just going to, for right now, assume that away. In the previous slide, we estimated a cost of capital, or early on in this chapter, a cost of capital of 10.41%, and we did that, of course, by multiplying all of these weights. When we're seeking to optimize our cost of capital, we have to just consider what the alternative structures might be. And let's do that by assuming we're going to sort of deal with a new firm, one where we haven't chosen to raise any money yet. And we're doing this to illustrate an important point. Notice here on this slide that our debt cost is less than our common equity cost. And that's always the case. Debt is always cheaper than equity. And the reason for that is that the debt holders get paid first. They're taking less risk at any given point in time than the equity holders are. However, let's consider a new firm that's considering raising capital. And it's considering three alternative plans, all right, which are Plan A, Plan B, Plan C. Now, in Plan A, they're going to choose debt to fund 20% of their company. And if they do that, the cost of debt is 6.5%, and they estimate that the cost of equity to fund the other 80% would be 12%. And we go through the process of calculating the weighted average cost of capital, and we find a value of 10.9%. Now, notice that in this instance, in Financial Plan A, that the cost of debt is less than the cost of equity. So it is very tempting to say, well, perhaps what we need to do is not raise 20% with equity, but maybe we ought to raise 40%, or rather 20% with debt. Maybe we should raise 40% with debt. So let's consider a different plan, Plan B, and we'll make Plan B in blue. And in Plan B, we're going to raise 40%. Now notice when we do that, if we're going to raise more capital through debt, the debt's a little bit riskier. If the bank is going to loan more money as a fraction of the assets, the bank's taking on a little more risk, or the bondholders are taking on a little more risk. So the cost of debt has actually gone up. Having said that, the equity holders now have more risk. They have to pay off the debt before they can pay themselves any dividends, and they've got more debt than they used to. Having more debt is riskier than less debt, so the cost of the risk on the equity has gone up, and therefore the cost of the equity has also gone up. So in each case, when you compare the previous cost of debt to the current cost of debt, the previous cost of equity to the current cost of equity, the costs have gone up. We go through the same process. calculate a weighted average cost of capital, multiply these out, and indeed we find that our weighted average cost of capital has gone down. Now, we look at this and we observe, well, with 40% debt, we can reduce our cost of capital to 10.3%. If that's the case, that's such a good thing, maybe we should take on even more debt. And with that in mind, we go to an even more aggressive financial plan where we say, let's just borrow 60% debt. And when we do that, the cost of debt is higher than it would have been. The cost of equity is also higher than it would have been. Notice, however, that debt is still cheaper than equity. It isn't that debt gets more expensive than equity, it's that the cost of both the debt and the equity are going up as we add more debt to the firm and make the firm more risky. All the stakeholders, the bondholders and the shareholders, look at this and say, gee, our risk is getting higher, we have to have a higher return. And when we go through the process of calculating our weighted average cost of capital, we find that now we have increased the weighted average cost of capital to 11.4%. So by taking on too much debt, our weighted average cost of capital actually rose from 10.3 to 11.4, even though we were using the cheaper source of capital, more debt. We're using less equity, but it's very expensive equity now. And so this just sort of illustrates an important point, which is, notice in all three plans that the debt was cheaper than the equity. However, it wasn't true that the weighted average cost of capital always got cheaper by adding debt, because as we add, even though we're using less equity, the equity is getting much more expensive over time. Let's graphically look at how we might view this. In blue here, we've got the cost of equity. In red, we have the cost of debt. And in black, in between, we've got a weighted average cost. Now, down here along the bottom, we have the assets to debt ratio. So at this point right here, or debt to assets ratio, along the axis here, we have no debt. And so taking on a little bit of debt is priced very close to the risk-free rate. There's a cost of equity associated with this as well. As we add more debt, the cost of debt rises. However, also the cost of equity rises. The weighted average, at least initially, when we're taking on more debt, we're enjoying the benefits of the government subsidy with its tax deduction of taking on debt. The debt is the cheaper source. This tax benefit has a big impact on our desire to use debt, and our overall weighted average cost of capital goes down. Having said that, beyond some point, the risks get so great, the possibility of bankruptcy gets so great, the possibility that the firm will become financially distressed gets so great, that there's some point at which the firm, if it goes beyond it, its overall cost of capital will go up. And that one of the objectives of the firm's financial policy is to try to figure out exactly what level of debt they should use in order to find that very minimum point right there. So in this case, the minimum point's about 40%. Now, one of the things that we need to recognize is that there's no way for management to know exactly where that minimum cost point is. It's very difficult to determine where the minimum cost point is. So the firm is going to have to make some judgments about that, constantly reassess whether or not they're at an appropriate level of debt and equity, and they make adjustments. But there's a great deal of research that has gone into trying to figure out what the optimal, what the perfect debt equity mix is, and and we still don't fully understand it. We know that when firms are not at the optimal point, it appears they try to get back toward the optimum, but they don't do it quickly in many cases. They do it rather slowly, and they seem to take into account other factors in the decision-making process. But the goal, nonetheless, is to minimize that weighted average cost of capital. Different firms will use different levels of debt. Some firms are use more debt than others. We can see here from 2007 debt as a percentage of total assets for a range of different firms. Some of these relatively high-tech firms use relatively little debt. That's in part because of perhaps the risks associated with high technology. There are other firms that use a lot of debt. AMR, American Airlines, where's that debt coming from? Well, they finance their airplanes with debt for the most part. If they lease these planes on long-term leases that are the equivalent of borrowing the money, and if they fail to make payments, lease payments, the lessor can take the plane, lease it to some other airline. But you can see a very wide range of debt to asset ratios. So there's not an obvious number as to what represents an appropriate amount of debt. It differs from industry to industry, and there tends to be a lot of clustering. And to some extent, executives look around at other firms in their industry and seem to have a desire to not deviate too much from what everybody else is doing. So that may be as big a driver as anything. Just what is everyone around me doing? Could we all be wrong? Probably not. I want to be somewhere close to what everybody else is. So again, we're looking for an optimal debt to equity mix, but knowing exactly what that optimum is more art than science.